We are always told that there can be a virtually unlimited amount of debt as long as it is manageable. 20 trillion in debt? No problem. It's manageable. A few years from now, we'll say 40 trillion in debt? No problem. Still manageable. Let's take a look at why this is just a fairy tale that we've been told. You came here for the truth, so let me unveil that for you. Today, we're going to look at America's debt problem. Let's begin with this. We are looking at a blog entry by Chris Hamilton. He got into some pretty good information here. I wanted to show it to you, show you the charts, because he really tells a tale in these images. Let's begin with this. US federal debt and the US debt to GDP. When you look at it through both of these lenses, you see that the problem is unsustainable. 21 trillion in debt and 105% of GDP is not manageable. But the debt continues to increase. More and more debt onto the backs of the taxpayers. So if we look at that $21 trillion, you could say it's manageable. But the debt to GDP continues to get worse. And that's a big problem. That's not being accounted for. Okay, that's one issue. US federal debt and the US full-time employees. So sometimes you'll see this rebuttal that there are more people working, more people in the workforce means more tax dollars. It's beneficial for the economy. Things are doing well. There are more people employed today than ever before. We hear all these lies. Well, take a look again at that $21 trillion debt, and you can see also the full-time employees heading up to a level of 127 here. This is the full-time employees in the millions. And so many people would say there are more full-time employees now. We're gaining on what happened before compared to 121 here in 2008. Things are doing well. Well, it's not exactly the case. Let's take a look at this. Debt against full-time jobs added per period. We have a very big problem on our hands, and I'm glad that there are charts like this that can really show it for us. And those who actually want to know the truth are going to look at this and say, oh, that makes sense. So you can see here, during this period of time, the amount of debt has escalated dramatically since the financial crisis, okay? We've seen that. We thought it was really bad leading up to the financial crisis, and then afterward it has escalated to new heights. Well, look at every time there's a recession, or maybe you want to look at it as basically as time goes on, less and less full-time employees are added, full-time jobs. That's not a good sign. When we really need them, they're not coming through. So back in the 90s, it's basically halved in terms of that amount afterwards. And then it's getting less and less and less every time. Every single time it's going to get worse unless something major changes. So far, we are seeing a lot of temporary jobs that have been added. That's not good. I mean, it's better than nothing, sure. But are temporary jobs the solution to the problems that we have? Of course not. Of course not. Temporary jobs are an epidemic, in fact. It's fine if you want to work a temporary job, if you enjoy your temporary job, but a lot of people don't. A lot of people get temp jobs because that's all they can get. They work the temp job, they work 2 or 3 temp jobs, that skews the numbers. At the same time, they are basically waiting, hoping for something better. A lot of times it doesn't happen. Okay, next. Debt per net full-time job added. I mean, it was pretty clear in the previous, but you can just see here, it is just escalating to new heights once again. It's a shocker to some that you would think, wow, there's that much debt in the system. But if you've been paying attention, and I'm sure you have, if you're watching this video, you'll know that this is the truth, that many people are overburdened by debt, and they feel it every day. Debt is that thing that hangs upon people every day. They are unable to shake it off. They carry it with them everywhere they go. And unfortunately, those who are employed still have this problem. Those who are unemployed are even in a worse issue. Growth of the debt per full-time employee dwarfs the growth of the disposable income per full-time employee. So you would say it's manageable. This debt is absolutely manageable, not an issue. Well, the growth of the debt per full-time employee, that was okay until the financial crisis. Escalating beyond any reason. And then the green line here, you can see that it is slowly and steadily, not in nominal terms, not in real terms, nominally increasing. So we have a huge chasm in between that has formed. Ever since that time, it's only getting worse. People are going to be in big trouble simply because they are unable to afford their daily expenses. Housing prices are too expensive. Rental prices are too expensive. So what are they doing? Well, unfortunately, they're going further and further into debt. It's a cycle that continues to repeat, and unfortunately, a lot of people aren't able to get out of it. It's a trap. Months necessary for all U.S. full-time employees, DPI, to pay off their federal debt. Imagine your disposable personal income here. How long this would take? Well, previously, it was a small amount, 4. Then it gets to become 7 in the 90s, then 9, then 11. That was terrible. Now it's 18. 18 months. And of course, there's no way out of it. I assure you, we'll be looking at these charts 2 years from now. These numbers will be significantly higher. You can't deleverage. It's impossible. That's what a lot of people aren't understanding. There are some who say, who cares about deleveraging? A Keynesian belief system and all this silly business, that you can just continue to do this without any repercussions. Unfortunately, at some point, there has to be repercussions because the... Take it for really what it is. I mean, you can't just take these statistics. We have to piece it together, all the other, 1,600 videos that I've done, the books I've written. Don't just cherry pick. That's what a lot of people do when they're naysaying. But look at this. We have a situation where there's all these derivatives that are underlying all the financial system, all the stocks and the bonds. That's one thing. They're a fraud on their own. But underlying that, you have these derivative products with no underlying asset, and yet they sit there just waiting, ready and waiting to destroy everything. We're going to have to see what happens. It's a ticking time bomb. You know that previously, what happened here was an issue nobody thought would be anything to worry about. Subprime mortgages, that's something else. Don't worry about it. We had all those mortgage-backed securities. We had all those different collateralized debt obligations. It's a small piece of the puzzle. Plus, they're diversified. We're talking about real estate from all over the U.S., top to bottom. It's fine. Rated AAA, nothing's going to happen. Suddenly, nobody was predicting it, okay? Just a small handful of people. And then, things changed in an instant. Of course, that will never happen again, right? Sure. 1790 to 2018, U.S. debt to GDP versus annual population growth percentage. And this is something of note. You can see that during these different time periods that go on. We have escalation of the debt. Right now, it's at an astronomical level. I mean, it's not even a consideration to compare back what was happening in 1790 to today, because it's gone completely out of whack. Look at the next chart here. Household net worth as a percentage of disposable income versus savings rate. Garbage. 2.4%. Why? Because more and more people are getting into, number one, your different type of stocks, bonds, ETFs. They're looking at all these, putting more and more into their homes, buying homes as an asset. And a lot of people are not sophisticated enough. They don't know what they're doing. And of course, it's going to be a big problem. 2.4% of your personal savings rate. That's an average. There's a lot of people who have nothing. They're completely running off of debt. That's a big issue, okay? But let's pretend that it's not for a moment here. Household net worth as a percentage of disposable income has accelerated to 677%. Now, that's not normal. It really isn't. Of course, it beats the records we've seen previously, but how many times have you heard me say that? There have been times in which things made sense, okay, or at least more sense. Right now, that's not one of those times, okay? When the average person has so little in terms of their actual, let's say, what they have on hand, compare that to previous times in history, it's completely out of whack. A lot of people today, a good majority of them, are buying their stocks, bonds, whatever the heck they're getting into, on leverage, on margin. It's worse. Actually, margin is worse than leverage. Think about how bad buying stocks on margin is. It can make you so much money on the way up, but just a fraction going downward, and immediately they're just completely destroyed. That's what people don't understand. They're thinking, hey, I get to own, let's say, 10 times the value of the stock. That means I get to profit 10 times as much. That's amazing. When the stocks are going up, congratulations. When the stocks are coming down, doesn't take much to put you out. So that's all for this video. If you found it informative, please give me a thumbs up. When you give me a thumbs up, that supports the channel, so I do appreciate it very much. Just want to thank each and every one of you out there in any way that you are supporting me, whether it's through thumbs up and comments and subscriptions to the channel. I do appreciate all of that. Or whether it's through Patreon or the cryptocurrencies, or whether it is through PayPal or anything else. I really do appreciate all of those, so thank you very much. If you're interested in taking a look through my books, there are links in the description of this video that you can check out to flip through them for yourself. Take care.